If I don't have the time or interest to search the companies, study the financial reports, and follow the stocks, can 2 or 3 broad market ETFs be used to build a simple portfolio? The answer is yes, and a lot of people are already doing it. But my question is, which ETFs should I use? From the bucket of Australian domestic market ETFs, do you buy VAS, A200, IOZ or STW? For the global market ETFs, do I buy VGS, VGBL, HGBL, IVV, SPY, VU plus VTS, or the ESG option IWLD? In this video, let's do a deep dive analysis of all the ETFs that I just mentioned based on their past performance since their inception, and try to find 1 or 2 optimized combos. My name is Arian, let's get started. Before we jump into comparing these ETFs head to head, let's zoom out for a moment and look at the bigger picture of building a simple ETF portfolio. Depending on how you like to invest, these 2 or 3 ETFs might represent a small part of your investments, the majority of it, or even your entire portfolio. So let's unpack this a bit. Some investors prefer what's called the all passive route. This means that their entire investment is in broad market index funds or ETFs. And I'm using the terms index funds and index ETFs interchangeably here because aside from a few structure differences, they essentially serve the same purpose. But even within these passive strategy, there are a few variations to consider. Let's start with the all passive approach, which is heavily embraced by the FIRE movement, Financial Independence Retire Early. The typical one is the lazy portfolio, aka the 3-fund portfolio. The idea is you invest in just 3 types of ETFs, one for your home country stock, one for international stocks, and one for bonds. And this way, you are spreading your investments across the entire stock and bond markets with minimal effort. That's like setting a slow cooker in the morning and coming home to a delicious meal. Here's how it can look with different fund families. If you use Vanguard only, you can use Vanguard Total Stock ETF VTI and Vanguard Total International Stock ETF VXUS plus Vanguard Total Bond Market ETF BND. If you use spiders, you can use THRK Spider Russell 3000 ETF plus Spider MSCI excluding US ETF CWI and Spider Bloomberg Aggregate Bond ETF BNDS. These are all the US-based ETFs. I've also covered how to build a similar portfolio with Australian ETFs in another video. Some people are not a fan of bonds, so they hold all shares index funds portfolio. A typical example of such is Aussie $5 FIRE portfolio, which I appreciate its transparency and accountability. While focusing on global and domestic shares, consider spicing things up with emerging market ETFs if you are optimistic about their growth. And remember, this approach doesn't cover cash holdings or commodities like precious metals. Ultimately, how you allocate your assets depends on your personal goals. Besides the all passive approach, there are people who would like to take a hybrid approach. For example, me. This approach is sometimes called the core satellite portfolio, and this could mean that you have passive index funds plus thematic ETFs plus individual stocks, bonds, rates, precious metals, and LEAPs. There are trickier questions that these investors face, and how much I should allocate to the core passive index funds and how much I should allocate to the others. Within the core, what would the asset allocation look like to each index fund? If you would like to see my monthly portfolio update, I have a link here. So when we talk about what investment products we purchase, the context, the logic, the why, the big picture is very crucial. It's not just like,
oh, pick these 2 ETFs to get rich.
It's not that at all. It's about crafting a strategy that aligns with your financial goals and risk tolerance. Now that we've set the stage with our investment strategies, let's dive into the specifics, starting with the Australian domestic market. Imagine we're in a financial supermarket and we're shopping for the best ETFs. In our shopping list, we have VAS, A200, IOZ, and STW. These are like different brands of the same product, each with its own features. Let's see if we can make our shopping a bit easier by comparing them. First, think of IOZ and STW as 2 very similar products on the shelf. They both have the same management fee and both offer a portfolio of 203 stocks. It's like choosing between the 2 types of apples that taste almost the same. After comparing their performance over time, it seems STW doesn't really stand out enough to keep in our basket. VAS, on the other hand, might have a higher fee, but it's like a bigger, juicier apple. It gives you access to 100 more stocks and has shown higher annual returns. So the actual cost else might just be worth it. A200 is another interesting choice. It has a lower fee and has performed well, but is tracking a different index compared to IOZ. So we're keeping both in our cart for now to see how they fare in a head-to-head comparison later on. We've got plenty of options on the global market ETFs, but how do you choose where to go? Let's break it down into three main groups. First up, we have World minus Australia ETFs, and this group includes options like VGS, VGBL, and VEU plus VTS combo. It's like exploring every corner of the world except your backyard, although VEU does have 5% Australia market. Among this, we found that HGBL is the hedged sibling of VGBL and offering protection against currency fluctuations. However, it comes with higher fee and hasn't performed as well, leading us to leave it out of our top picks. The combination of VEU plus VTS can get you nearly the entire global market of large and mid-cap companies, boasting an impressive 7,000 holdings. But they come with a catch. Being US domicile brings potential tax complexities for Australian investors. Next, we zoom into the US market. Given that US stocks often dominate global ETFs by weight, some argue why not just invest directly in the US market. Indeed, the US market ETFs like IVV and SPY, which both track the S&P 500, offer a focused slice of the US market. Interestingly, despite its lower fees, IVV's return since inception is modest, possibly influenced by a stock split in 2022, yet we're keeping IVV in the running to see how it really performs over time. Similar to VEU and VTS, SPY is also US dollars domiciled. Finally, for those passionate about sustainable investing, IWLD stands out as the lone warrior in the ESG option, excluding Australian companies. It's more selective, housing 672 companies that meet strict environmental and ethical standards, compared to the 1,000 plus in its peers. It's for investors who want their dollars to support a greener, more responsible world market. To make our comparison as fair as possible, I'm using ShareSite, an investment tracking tool, to see how these ETFs combinations have really performed over time. We're not adding any more money after the initial investment. We want to see how they grow on their own. For the VTS plus VEU combination, we have given them an equal weight in our global market basket. So we have 3 times 6, 18 different combinations that cost me 1 hour. First in the rank, we have VAS. How does VAS fare when it teams up with different global ETFs? Does it deliver a knockout performance, or does it need a stronger partner to shine? So here's what I did. Hypothetically, I invested $10,000 in VAS and $10,000 in a global market ETF since inception. With no additional contributions, dividends are automatically reinvested. The winner is VAS plus VTS plus VEU with 18.5% annual return, 12% in capital gain, and 6.4% in income return. Next, we're looking at A200 plus its global partners. Equal weight 2 ETF portfolio, A200 with SPY sits on the first place with almost 22% total annual return. Finally, let's look at the IOZ plus its global partners. The winner is IOZ plus VTS plus VEU with 17.3% in total annual returns. If we mingle all of the combinations, here are the top 3 winners based on the equal weighting between Australian market and global market. Interestingly, the top 3 winners are all from the A200 camp, but if we go back to see A200's performance alone, it's not even that impressive. The famous combo of VAS plus VGS underperformed A200 plus SPY by almost 7%. It's also worth noting that any portfolio that has US concentrated like SPY, IVV, VTS had better returns. The comparison I did was based on a rigid 50-50 weight, and also past performance is not a guarantee of future returns. Your asset allocation will naturally vary to reflect your personal financial goals, risk tolerance, and investment timeline. But I hope this video can answer your questions you may have and lay out some options for you, no matter you are about to start investing or you are a passive index fund expert. My name is Irene. Happy investing. I'll see you in the next video. Bye.